Today we are looking at Shell PLC, ticker symbol Shell, currently trading at $71.66 a share. It is currently up 14% from the start of the year, beating out some of its closest competitors in Exxon, Chevron, and even Warren Buffett's favorite, Occidental Petroleum. What we're going to be doing is looking at the stock price, comparing it to the market, then looking at my automated stock valuation spreadsheet to see if Shell is a buy using this discounted free cash flow model, the comparable company model, the dividend discount model, and of course the Ben Graham formula for intrinsic value. Speaking of dividends, this is a favorite among dividend investors, paying a dividend yield of around about 3.84%, which would net the shareholders $2.75 a share. If you're interested in the stock, the ex-dividend has just been reached, which was the 16th of August. So if you've owned the shares at that time, then good for you. If not, it will be 3 months after that date. So as I said, the stock price is around about $71 a share. If we look over the last 5 years, yes, we can see it doesn't look that great, up only 30%. But from the bottom of the pandemic, this stock has been on a very high growth, up almost 190% in that time. So let's have a look at my automated stock valuation spreadsheet. Firstly, we just put in the ticker here, Shell, and what this will do is it will load up all the company financial data so we can have a deeper look here. Firstly, let's have a look at the PE ratio, quite low, around about 12.81, with a market average of around 29. This is looking good already. Earnings per share, $5.59 a share, and a beta of 0.58, meaning it is much less volatile than the market. Analysts saying it's a buy with $84 a share. As I said, dividend 3.84%, which nets a dividend per share of $2.75. Total dividend, the Shell payout is around about 8.6 billion. It is safe with a payout ratio of 46% and a free cash flow payout ratio of 30%. So let's have a look at the financials of the company here. We'll be looking at revenue. Revenue currently 295 billion, down from 2023. As you can see, revenue has been declining, but since about the pandemic, they have been able to ramp that back up in the positive direction. Net income, this is the profit. Very profitable company, around about 18.39 billion, down from the highs of 2022, which was all-time highs of 42 billion, but we can see that they are very consistent in their profit. Free cash flow, a very similar story, but they are generating more and more free cash flow over time. We're going to exclude the 2022 number, which was all-time highs once again, but you can see free cash flow is growing, which is what they're using to pay, for example, the dividend, which a lot of investors like. Shares outstanding, what are they doing? Well, you can see they've actually been buying back their shares consistently over the last 6 years, which means they are rewarding shareholders because shareholders now own more of the profit. Now, let's have a look at the discounted free cash flow model. This is a way of valuing a company, looking at the future free cash flows, discounting them to today's value, and then we'll see if it is a buy or a sell. So based on the averages here, it does have a calculated stock price of $61 a share. So let's have a look at the numbers here. Firstly, we'll look at the revenue growth rate. Revenue growth rate is all over the place. You can see they had 30% in 21 and 22, and then down in those years, in the following years. So let's have a look at what analysts are saying in terms of growth rate and revenue estimates. 286 in the current year and 309 in 2025. So we're probably a bit on the bullish side as well. We'll even bring that down just a bit. If we were to look at what analysts are expecting growth over the next 5 years, they are expecting around about 4% growth per annum. So you know what, we'll see what the average is here, and we're going 5%. I think that's fair. Net income margins, we'll take an average of these years here. In fact, we'll look at about 6.4%, which is the more recent years, and that brings it actually to a $94 stock. And now, if we look at the free cash flow to net income, we'll keep an average of these. And yes, that gives us a stock price of $94 a share. Next, we will look, we'll quickly actually have a look at the dividend discount model. This is a way of valuing based on their dividends. And you can see this currently gives a intrinsic value of $82 a share based on the dividend growth and the discount rate. So that is looking quite promising there. Now, let's have a look at the comparable company model. If you're interested in this sheet, please check out my Patreon. Links are in the description. So we'll add in some comparable companies. One that I'm thinking of immediately is Exxon, ticker symbol XOM. Next is Chevron, which I believe is CVX share price. Let me just no, that's something else. CVX is probably Chevron. Yep, CVX, and then we'll go with BP as well, British Petroleum. So what this will do is it will load all the company's financial data, the comparable companies, and we can look at certain metrics to see if this is a buy or a sell. I've also added in the share price for each of these, so you can see the graph over time. If you were to change this to 30 days, this will load and show the 30-day 255, which is of course the year. So you can put whatever days you want, and then just gives you a quick glance of what the stock prices are doing. Although having a quick glance, oh no, they are the same. CVX and BP are trailing very close, and Shell and Exxon are also trailing very close. Quite interesting to see. So what we're looking at here is these metrics here: EV to EBITDA, EV to revenue, and PE ratio. But also things that I'm looking at is the revenue growth rate, profit margins as well, price to book, price to sales, and PEG, which is Peter Lynch's price to earnings growth. In terms of enterprise value, they're all pretty similar, with Exxon being the largest. Revenue, despite Exxon's larger enterprise value, $350 billion in revenue, Shell is pretty close with 300. Revenue growth rate, these are decreasing over the last 5 years, obviously because of the pre-COVID numbers, but Exxon and Chevron have been able to maintain revenue growth rate. They're all very profitable, with Exxon and Chevron being the highest, then Shell. So price to sales, price to book, and PEG ratio, you can see that sort of Shell is in the middle of all of these. EV to revenue, it is one of the lowest, which we want to see. EV to EBITDA in the middle again, and PE ratio is the lowest. So if we take an average of all of these, it gives an implied market share value of around about $71 a share, meaning it's not a buy. But this is because of the EV to EBITDA being a lot lower here, $56, whereas EV to revenue and PE, it is saying it's a buy. So depends how you would weigh these, but on average, it is saying that it is not a buy. And finally, let's have a look at the Ben Graham formula for intrinsic value. This is a way of valuing a stock using earnings per share, the PE of a no-growth company, the AAA bond yield, and of course the current bond yield. Obviously, very high inflationary environment at the minute, with the bond yield being 5.12%. I believe we saw that analyst estimates of growth is around about 4%, so I'm going to say this is not a buy. We'll bring this down, and yes, it says it is not a buy currently. So overall, this stock is deemed sort of fairly valued based on the comparable company model. The discounted free cash flow model does say it's a buy, and the Ben Graham formula for intrinsic value says it's a little overvalued. This stock, if we go over the last sort of max, it is coming to those all-time highs. So is there more growth that can happen? That is yet to be seen. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already. Check my Patreon, which is somewhere here. And I'll catch you guys next time.